Hello, welcome everybody to today's presentation on advanced 1031 exchange strategies. My name is Jeff Stechmann, and I'm the Business Development Director for Asset Exchange Company. Before we kind of get started, I know there are a few people joining in. I'll make a note of, let's make a note of how we're going to handle today's presentation. Don't feel like you have to write every single thing down. Because you will receive a link to the recording of today's presentation, and also a lot of the topics that I'm going to talk about today. I have a lot of those in just single-page PDFs. If you'd like to have those PDFs emailed to you, just let me know. My contact information is on the screen, along with my phone number, and I'll show that at the end again. And as far as questions go, I'll open the floor up to questions at the very end. There's a box on the right-hand side that says questions, and right there is where you'd want to type in your questions. But again, let's leave that to the end, because I find in a lot of cases, if you do have a question, most often it'll be covered in an upcoming slide. So again, I'll introduce myself because I know we had a few people join in a little bit late. Again, my name is Jeff Stechmann. I'm the Business Development Director for Asset Exchange Company. To kind of give you guys some information about my background, I've actually been in the business for 25 years. I did a lot on the title side of the business to get my start. I always say this in every presentation that I do. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I live in Florida, in the Tampa area, and I've lived in Florida 22 out of those 25 years. As I mentioned, I got my start in the title side of the business. I've done just about everything there is to do on the title side. Being that I've been doing it as long as I have, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And hopefully we never have to experience those bad times again. I know right now things are a little bit slow because of the shutdown, but hopefully in the next few months we can get back to some form of normalcy, and because things were going good. First part of the year, first few months of the year, things were great. Typically pick up in March and April anyway. So let's dive right in. I'll give y'all some information about the company. So we're Asset Exchange Company, and we've been in business since 2006. And over the course of our existence, we've done about 30,000 1031 exchanges. It's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, we're known as a qualified intermediary, QI for short. Now, other terms you may hear people refer to is an accommodator. Another term is a facilitator, or just simply an intermediary. But at least in our neck of the woods here in Florida, people call us QIs. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. Well, we hold the proceeds on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. And we're going to talk about that in more details in just a few minutes in an upcoming slide or slides. Now, word of caution about QIs. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So what does that mean exactly, right? Well, what that means is anybody out there can be a QI, can be a qualified intermediary. There's no type of requirements that you have to have any type of E&O insurance. There's no type of requirements you have to be bonded. There's no guidelines on where you hold the proceeds, the type of funds you hold the proceeds in. It's a really scary thought when you think about it. So if any of you guys on the line are currently involved with the 1031 exchange, please just make sure you have done your due diligence and you're dealing with a reputable company. All right. Great news when you deal with us. We're actually based out of California. Our home office is in San Francisco. And because we're based out of California, the state of California actually has a state agency referred to as the Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. There's guidelines on the financial institutions where we hold those proceeds. There's guidelines on the type of funds we hold those proceeds in. We're subject to audit by that franchise tax board, which is great for anybody that deals with us in California, right? But anything that we do nationwide, because we do 1031 exchanges all over the country. Well, that franchise tax board has oversight in anything that we do, right? Because as I mentioned, they can come into our office and audit any of the files that we're working on. It's not just California property, but anything that we do in any state. So again, there is oversight when you deal with us with that franchise tax board. Now, as far as our ownership goes, we're actually owned by two gentlemen. They've been in the 1031 exchange business specifically for, 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on tax and real estate, that type of thing. The reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with. If for some reason they were to get audited by the IRS after the exchange was completed, we would actually provide free audit support. All right, we would work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney, Adam Skarsgård. All right, so another good reason to deal with us. All right, so let's talk a little bit about why investors exchange. Well, the most obvious reason, or the single most reason that we see, is to defer taxes. So typically when you sell real property, all right, if you have a gain in that property, on average, about a third of that gain goes towards paying taxes. So that's the single most reason that we see people doing 1031 exchanges is to defer those taxes. But what are some of the other things that we see? Well, I call it buy more property. So, with 1031 exchange, one of the rules to exchanging is the replacement property that gets purchased in a 1031 exchange. Well, that purchase price must be equal to or greater than whatever the sales price was on the relinquished property. All right, so what an investor will do is they use the savings of not having to cut that check to the government, right, by doing a 1031 exchange, and they use that savings to hopefully to leverage that into helping themselves buy a better property. All right, hopefully it's going to be a higher dollar property and a higher, better income producing property as well. Right? What are some of the other things that we see? Well, diversification and management relief, geographic diversification. With exchanging, you're not limited to just selling one property and buying one replacement property. All right, you can do that, or you could even sell one property and buy multiple properties. You could even sell multiple properties in a 1031 exchange and replace it with a single property. It doesn't matter. All right, so geographic diversification. I'll give you guys an example. Let's just say you sell a property in California, right? Now, California has some of the highest property values in the entire country, right? So you sell that property in California in a 1031 exchange, that investment property, and instead of buying a replacement property in California, you go out and you buy a replacement property, let's say here in Florida. Maybe you buy another one in Texas, and who knows, maybe even buy a third one, I don't know, maybe like Ohio, somewhere like that. That way you're not so geographically tied in to one particular real estate market, right? Because hey, if the property located here in Florida, if the real estate market starts to go down again in Florida, well, you got that other property in Texas and you have that other one in Ohio. hopefully those markets would not be experiencing the same downturn that we would be experiencing here in Florida. All right, so geographic diversification, management relief. I'll give you guys another example with management relief. I have a guy who lives in New York. All right, he owns 4 rental properties. All right. Now, what he would like to do is he'd like to retire and he'd like to move to Florida. Okay. But you know what? He doesn't want to manage property anymore. So, what he would like to do is he'd like to sell all 4 of those rental properties in one 1031 exchange and buy a replacement property somewhere in Florida, maybe like an apartment complex that has some on-site management. All right, somewhere in Florida where he's going to retire, right? Because why? Because he doesn't want to manage those properties anymore. All right, he basically just wants to retire and collect a check every month. Well, 1031 exchange is perfect for somebody like him. All right. What else do we see? Well, with exchanging, people will actually use 1031 exchange as an estate planning tool. All right. So with exchanging, you're not limited to how many times you can even do a 1031 exchange. All right. I could buy investment property today, hold on to it for a period of time, at some point sell it in a 1031 exchange and defer my taxes. The next property I buy, investment property out of that 1031 exchange, right? I can hold on to that for a period of years, at some point sell that and do another 1031 exchange and defer my taxes again. And I can keep doing that over and over and over throughout the course of my lifetime. I can keep deferring my taxes. Now, what happens is when I die, all right, when I pass on, if I have any heirs that inherit my property, well, they're going to get what's referred to as a step up in basis, all right? And what that means basically is whatever the value of the property is when they inherit it, well, that's their basis, all right? All of those deferrals that I would have done over the course of my lifetime, basically they go away and no one ever has to pay the taxes, all right? So remember that, the step up in basis, all right? Your heirs will benefit from all those deferrals where they don't have to pay the taxes. Now, here's an example how that could work. Let's say I'm the heir, right? I inherit the property, right? Now I may look at it and say, gosh, this is a great property. It's a nice investment property, has some nice cash flow every month. I'm going to hold on to it for my purposes as an investment. Now, if I hold on to the property for a period of years, however long it may be, when I go to sell the property, if I have any gain in the property from when I inherited it to when I sell it, I could do my own 1031 exchange and defer my taxes and basically start the whole thing over again. All right. So again, estate planning too. I'll remember that. That's important, especially for a lot of people that live here in Florida, because people like to retire here. They'll buy investment property, and then again, when they pass on, their heirs get to step up in basis. Right now, what are current tax rates? So typically, when you sell real property, all right, if you have any gain in the property, you're going to be subject to capital gains taxes. Right now, capital gains taxes right now is either 15% or 20%. Right now, the 15% was historically applied if you were single and you had income of less than $400,000 a year. If you were married, you had income of less than $450,000 a year. That's where you're at the 15%. Now, the 20% historically kicked in if you were single, you had income of greater than $400,000 a year, or if you were married, you had income of greater than $450,000 a year. That's where you're at the 20%. Now, the income levels, I think they've been adjusted a little bit. They're a little bit higher now, but either way, you're still going to be looking at either 15 or 20% capital gains taxes, all right? Now, you're also going to be subject to what they refer to as depreciation recapture tax. Now, that's an additional 25% tax. Now, how does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in the property, all right, for the total time that you've owned the property, when you go to sell that property, they're going to hit you with a 25% tax just on the depreciation alone. All right. Now, on top of that tax, you may also be subject to what they refer to as the Medicare tax. All right. That's an additional 3.8% tax. Now, what exactly is that all about? Well, the Medicare tax was passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the costs of the Affordable Care Act. All right. So when you do a 1031 exchange, you can defer having to pay any of these taxes. All right. Now, what am I not listing up there? Well, I'm not listing anything to do with state income taxes. All right. For those of y'all on the line that are located in Florida, like me, well, we don't have state income taxes, so we don't need to worry about it. But if we live in a state, or even if we're selling property in a state that has state income taxes, we would also be subject to the state income taxes. All right. When you do a 1031 exchange, you can also avoid having to pay those state income taxes. All right. Now, every state has their own way of you going about filling out some type of form or some type of process for you to go about getting that exemption. A couple of years ago, we did an exchange for a lady. She was a Florida resident, but I believe she was selling property in Maryland. All right, where Maryland has state income taxes. So what they required her to do is she had to complete this form like 21 days prior to closing. All right, we had to sign off on it, and that's how she got the benefit of not having to pay the state income taxes. All right. So again, every state kind of has their own way of you going about filling out some type of form or some process. All right. But again, the good news is when you do a 1031 exchange, you can avoid those state taxes in addition to the federal taxes, as we just went over. All right. Now, how do you actually calculate what the taxes are, what the gain is? Well, this is typically done by a CPA, all right, but I'm going to run y'all through some quick numbers, all right, just to give you an example, like ballpark of what an investor could potentially be looking at having to pay in taxes, all right. So in our example, all right, originally we purchased the property for $500,000. Now, over the lifetime that we owned the property, we made capital improvements of $25,000, all right? And then we took some depreciation for the lifetime that we owned it, all right? We took $100,000 worth of depreciation. Now, we're going to go ahead and we're going to sell the property for $1 million, all right? So in order to calculate what the taxes are, the first thing you need to do is you have to be able to calculate what they refer to as adjusted basis, right? And basically the way you do that is you take the original purchase price of $500,000, you add in the capital improvements of $25,000, all right? And then you deduct out any depreciation that you took. In our case, it was $100,000. And that gives us an adjusted basis of $425,000, right? Now, we're going to sell the property for $1 million, so we take that $1 million sales price, deduct out the adjusted basis of $425,000, and that actually gives us a gain of $575,000. Now, out of that number, how much of that was depreciation? $100,000 of it was, right? We're going to take that $100,000 out because that depreciation recapture tax, that 25% tax, they calculate that at a separate line item, all right? So we'll take the $100,000 out, multiply that times the 25% depreciation recapture tax, and that would give us a tax of $25,000. Now, how much do we have left over after taking out the depreciation? $475,000, right? Now, let's just say we're at the highest capital gains tax rate of 20%. So we'll take that $475,000, multiply it times the 20% capital gains tax rate, and that would give us a tax of $95,000. All right. Now, let's just also say we're going to be subject to the Medicare tax of the 3.8%. So we'll take the $475,000, multiply it times the 3.8% Medicare tax, and that would give us a tax of $18,050. So when we sell this property, we would be looking at having to pay taxes of $138,050. All right. Again, when you do a 1031 exchange, you can defer having to pay all of these taxes. All right. Now, what am I not listing up there? Again, state income taxes, right? So again, if you live in a state or if you're selling property in a state, you'd also have to calculate that in, right? So for those of y'all that are on the line that are realtors, right, think about this for a minute. If that's your client, right, and your client is sitting there thinking they're going to have to cut a check for $138,050, and then whatever's left over, now let's go out and find you some replacement property, right? Well, just think about this. If you're the one that brings it to the table and you say, hey, that check you're going to have to write for $138,050, do a 1031 exchange, defer all those taxes. Now let's go out and find you something even better, right? Well, it's win-win all around, right? The client wins. Why? Because the client saves on the taxes. They win also because Now they just have that much more to use to go out and buy that replacement property. Hopefully, it's going to be a higher dollar property, right? And you win as well because why? Because hey, you look like a rock star to the client, and what? Because now they can go out and buy a better property. Hopefully, you just increase your commissions, all by recommending a 1031 exchange. Sometimes, for those realtors on the line that are here in Florida, right? I mean, we have so many people that want to move to Florida. They're constantly every month, right? Investors that are looking to buy property here. Maybe they live in another state. If they, let's just say they live in New York, all right? Well, New York has state income taxes. They have city taxes, county taxes, right? It's crazy. Maybe you're not even involved with the listing part of the deal, right? You're going to be helping them find some investment replacement property, right? If you know that they're selling investment property and they're not talking about doing a 1031 exchange, it's the perfect opportunity to talk to them about it, because especially if they live in a state that has state income taxes, because they just have that much more to gain out of it, right? They're going to save on their federal taxes, and they're also going to save on those state taxes as well, all right? So some things to think about. All right, so what are some of the tax advantages when you sell real property? So with a 1031 exchange, let's review, all right? What can you do a 1031 exchange on? Well, any type of real property that you use in your trade or business, or that you hold for investment, all right, you can exchange it for any other type of real property, all right, that you use in your trade or business or you hold for investment, all right? And 1031 exchanging is a tax deferral, right? It's not a tax avoidance, all right? Tax deferral being that if you don't continue to do a 1031 exchange, you may be subject to having to pay those taxes. I gave you all the example with estate planning, right? I said you're not limited to how many times you can do a 1031 exchange, right? You can keep deferring and deferring. But let's say maybe it's the third time you've done two 1031 exchanges, and the next time you go to sell your replacement, your property, you say, you know what? I don't want to do a 1031 exchange. I'm okay with just paying the taxes and cashing out. Well, you're going to be subject to those taxes, and all of those deferrals that you did up until that point, you also are going to be subject to having to pay those taxes, because 1031 exchange is a tax deferral. It's not a tax avoidance, right? It's a tax deferral. But what? If you die correctly, you may never have to pay them, all right? I always make that joke, if you die correctly, because remember, that step up in basis, right? When you pass on, if your heirs inherit that property, they're going to get that step up in basis, and no one ever is going to have to pay those taxes. Those taxes, the heirs are not responsible for paying them, all right? Now, what about your primary home? Can you do a 1031 exchange in your primary? And the answer is no, all right? On your primary, you may qualify for what they refer to as a Section 121, all right? And the way the 121 works is you had to have lived in the property for 2 years as your primary, all right? When you go to sell that property, your primary, if you have any gain in the property, the first $250,000 of any gain, if you're single, is tax exempt. If you're married, the first $500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it, all right? It's like a one and done. It's not like a deferral with 1031 where you may have to pay it someday. With the 121, it's one and done, all right? You don't need anybody like me to help you with that. With the 121, it's just something that you file on your tax return on the year that you sell your primary residential home, all right? Now, here's an example of how the 121 works, all right? Let's just say we buy a primary, a residential home, our primary in 2010. Now we buy for $100,000. All right. Now, buy it in 2010. Now we're going to live in it for 5+ years. All right. Now in 2016, we're going to sell the property. All right. Now we're going to sell it for $1 million. Now I know what you're thinking, man, that's a great deal, right? Man, we bought it for $100,000. We're selling it for $1 million. I don't know if there's any deals like that here in Florida. Maybe there are. I don't know of any, but maybe it's California or New York property, the way property values have skyrocketed, right? But we'll keep the numbers simple too, all right? So we're going to sell it for $1 million. We bought it for $100,000. So our gain's $900,000. Now we know that's not exactly how you calculate it, right? Because we just went over the example. You got to figure out adjusted basis. You got to know the depreciation, but let's keep the numbers really simple, all right? So we have a $900,000 gain. All right, so we're going to sell it in 2016. Now we're married when we sell it, so it qualifies for 121 because we've lived in it for at least 2 years as our primary. All right, so because we're married, the first 500,000 of the 900,000 would claim the 121, and that portion of the gain will be tax exempt. All right, but the problem is we still have another $400,000 of gain that we're going to have to pay when we sell the property in 2016. All right, that's going to equate to about $130,000 in taxes when we sell that property in 2016. Now, what if we could do this? What if we had the ability in 2016, instead of selling the property, we converted to an investment property? We converted to a rental property, all right? Now, let's just say we're going to rent the property out for 2 years, all right? And in 2018, now we're going to sell it in 2018. Now, we'll keep the numbers the same. We're still going to sell it for $1 million, and we're still married, all right? Now, because we're selling it in 2018 and it's an investment property, it now qualifies for 1031 exchange, all right? We can actually do a combination of a 1031 and a 121, all right? The guidelines for those, that is, you had to have owned the property for at least 5 years, all right? And you had to have lived in the property any 2 out of those 5 years as your primary, all right? So now, when we sell it in 2018, all right, we're still married. So the first 500,000, we're going to claim the 121. That portion of the gain will be tax exempt, and the remainder of the gain, the 400,000, we're back in 2016. We're having to pay taxes on it. Now we can claim a 1031 exchange on that portion of the gain, defer that portion via the 1031 exchange. So when we sell it in 2018, we pay no taxes. All right, pretty cool, right? Hey, look, here's another way you can do it too. Whoops. I took out that slide, but what if you wanted to buy a duplex, all right? Maybe it works the same way. You want to live in half of it, and you want to rent out the other half. Again, when you go to sell the property, if you've owned it for at least 5 years, lived in that half for at least 2 out of those 5 years, you can do the 1031 and the 121, all right? Half of it you can claim the 121, the other half you can do a 1031 on that portion of it, all right? Now, who can actually do a 1031 exchange? You know, with exchanging, whoever the taxpayer is in the sale of the relinquished property, that's the property that's being sold, need to be the same taxpayer in the purchase of the replacement property, all right? So individuals can do 1031 exchanges, husband and wives, spouses. Sometimes we see this with spouses. What if one of the parties, let's say they own an investment property prior to being married. Let's just say it's the wife, all right? She owns a rental property, right, an investment property prior to being married. So she gets married. And then during the course of the marriage, she decides she wants to sell that property, sell the investment property, the rental property, in a 1031 exchange because she wants to defer the taxes. And she wants to go out and buy another investment property, another rental property. But in order to buy that investment property, all right, that new rental property, she needs to get a loan, all right? And she has to bring in her husband's income to qualify in order to get that loan, all right, to buy that new replacement property. So how can you do it? All right, well, one solution that maybe would work, all right, you'd have to get the lender's approval, all right? You could possibly do this. Now, there's a type of ownership. It's referred to as tenants in common, all right? For those of y'all that don't know what tenants in common is, tenants in common, you can actually own a certain percentage of a property, all right? So what you could do possibly, again, is maybe you bring the wife in as a 99% tenant in common, and then let's just say you bring the husband in as a 1% tenant in common, all right? Again, if the lender would go for those terms, hey, you could get the loan and move forward and buy that replacement property with the mortgage, all right? That brings me to the next point. Tenant in common owners can do 1031 exchanges, all right? I'll give you guys an example. What if I want to go out and I want to buy an investment property, all right? But I want to bring somebody else in with me to help me buy that property. Now, we're going to be tenant in common owners, right? I'm going to own 50% and he's going to own 50%, all right? So we buy the property together as tenant in common owners, 50-50. hold on to that property for a number of years, whatever it may be, okay? And then at some point we say, okay, we want to sell the property. Now, for me, I'd like to take my 50% tenant in common ownership, do a 1031 exchange, defer my taxes, and I'd like to go out and buy another investment property. But my other tenant in common owner, he says, you know what? I have no desire to buy another investment property. I'm fine with just cashing out and paying my taxes. Well, he can do that, all right? And I also have the option to do what I want to do, all right? I want to do a 1031 exchange, defer my taxes, and buy an investment property, no problem. He could do his own 1031 exchange if he wanted to and defer his taxes and buy an investment property, all right? So, investment replacement property. So, tenant and common owners can do 1031 exchanges. Any type of legal entity that owns real property can do a 1031 exchange, all right? Corporations, partnerships, trusts, LLCs, all right? Sometimes we see this with LLCs, all right? Let's just say you have a single member disregarded LLC, all right? Now, disregarded meaning that actual LLC, you don't file a separate tax return for that LLC. At the end of the year, you just put anything to do with that LLC, you put it on your personal taxes, all right? So for tax purposes, that's referred to as a disregarded entity, all right? Because the entity and you as an individual are one and the same because it's all going on one tax return. So what happens sometimes with 1031 exchanges, let's say you sell the property, you own the property initially that you're selling as an individual. Well, the replacement property that you buy can be in your name as an individual, or it can be in the name of your disregarded LLC, your disregarded entity, all right? Because why? Because they're all one and the same, all right? It works just the opposite way, too. If you own a property in a disregarded entity, all right, that single member LLC, when you sell that in a 1031 exchange, a replacement property can be in the name of you as an individual or your disregarded single member LLC, all right? Sometimes we see this. Let's say somebody goes out and they're going to buy 1234 Main Street. All right. So what do? Well, they go out and create 1234 Main Street LLC. Now that LLC is a disregarded entity. All right. Meaning, again, they don't file a separate tax return for 1234 Main Street LLC. They just put everything on their personal taxes. Right. So they buy that. It's an investment property. They hold on to it for years. And at some point they say, okay, we want to sell it. All right. Now they're going to do a 1031 exchange because they want to defer the taxes, but they're going to go out. They're going to go buy 5678 Central Avenue. Well, you know what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? Well, they go out and create 5678 Central Avenue LLC. That's also a disregarded entity, right? Where they're not going to file a separate tax return for that entity either. They can do that because why? Because those disregarded entities are all one and the same, and they're all one and the same with the individual taxpayer because they're all going on one tax return. All right. Now, if it's a regarded entity, if the entity itself files a separate tax return, all right, for the entity, then if that entity sells that real property, that entity needs to be the purchaser in the replacement property. All right. Now, sometimes we see this with partnerships, right? Sometimes when a partnership sells real property, or it could be a multi-member LLC, whatever it may be, that's a regarded entity, all right? Sometimes the individual partners, when they sell the real property, well, the individual partners have different goals, right? You might have one partner that says, gosh, I'd love to do a 1031 exchange, or I think we should do a 1031 exchange, the company, the partnership, defer our taxes, and buy some replacement property. But you might have another partner that says, you know what, I don't think we should do a 1031 exchange. I don't think we should buy any additional replacement properties. I think we should just cash out and go our separate ways, all right? Well, how can you do that, right? Because again, whoever the taxpayer is in the sale of the relinquished property needs to be the same taxpayer in the purchase of the replacement property, right? So here's two solutions, all right? Now, these are actual terms that we use in the industry, right? I kid you not. They sound a little quirky, but I kid you not, these are actual terms that we use, all right? So the first one's referred to as a drop and swap, all right? Now, The drop and swap can work something like this. All right, let's say we have a multi-member partnership, LLC, whatever it may be. Let's just say we have 3 partners, all right? So what happens in the drop portion of the drop and swap, all right, the actual partnership will be dissolved. That's the drop, all right? The partnership gets dissolved, all right, and then they change the ownership structure of the property into tenants in common, all right, where basically each former partner becomes a tenant in common owner. Basically, each of them own a third of the property, all right? Now, as tenant in common owners, they're going to have to hold on to the property for at least a year or two. Because why? Because they have to show their intent that they're holding a property for investment. All right. Now, after the year or two passes, then they can do the swap. Then they can sell the property. All right. And then each tenant in common owner can do what they want. All right. One wants to do a 1031 exchange and defer the taxes. They can do that. Another one wants to sell the property outright, just walk away from the property, pay their taxes. They can do that. All right. When they sell it. All right. Now, it's going to take some time, right? It's probably going to take a year or two before all of this takes place, right? Before everything gets resolved, right? Now, the other type of solution would be what's referred to as a swap and drop, right? It just works just the opposite of a drop and swap, where the swap portion works like this, all right? You still have that 3-member partnership, all right? So what happens is in the swap portion of it, the actual partnership itself will sell the real property in a 1031 exchange, all right? Now, what the partnership goes out and buys, instead of buying 1 replacement property, the partnership goes out and buys 3 replacement properties. Now, why 3? Because, hey, they had 3 partners, right? And the thinking is each partner is going to kind of have a say in which properties the partnership buys, all right? So the partnership buys those 3 properties. Now, as the partnership's going to have to hold on to those 3 properties probably for a year or two, all right? Because the partnership needs to show that it's holding those properties with the intent for investment, right? After the year or two passes, then they do the drop. Then they dissolve the partnership, and then each partner gets one of the properties, all right? And then they can do what they want with it. Again, with either one of these scenarios, right, it's going to take some time. It's probably going to take a year or two before it all gets resolved, all right? There has to be some type of agreement between the partners that they're willing to get along with each other for the next year or two. Sometimes with partnerships, it's not like that, all right? The whole reason they're looking to sell is because they're at each other's throat. They can't stand each other, right? They want to get away from each other, right? So there has to be some type of agreement that they're willing to at least work with each other for the next year or two. If not, then it's going to be difficult to do either one of these solutions, all right? So that's partnerships. Now, I know we have a lot of realtors on the line today, all right? So why is exchanging beneficial to you guys as realtors? Well, for one thing, with exchanging, there's always going to be 2 transactions, all right? There's always going to be a sale of the relinquished property, all right? And there's always going to be a purchase of a replacement property, all right? So 2 transactions. Hey, what does that mean for you as a realtor? 2 commissions, right? Now, one of the rules to exchanging, again, the replacement property that gets purchased in a 1031 exchange, all right, that purchase price must be equal to or greater than whatever the sales price was on the property that was sold, the relinquished property, all right? So what does that mean for you guys as realtors? What that means is the commission that you make on the replacement property is going to be as good, if not better, than what it was on the relinquished property because of that rule, all right? The client's 1031 tax savings benefit. We've kind of already talked about that. Think back to the example, right? The client sitting there thinking they'd have to pay $138,050 in taxes. Again, if you're the one that brings it to the table and you show to them they can do a 1031 exchange, save those taxes, use that additional savings to go out and buy a better property. Hopefully it's a higher dollar property. Hey, hopefully you just increase your commissions by recommending 1031 exchange, right? Now, sometimes we see this. Sometimes the seller of the replacement property, the property that's being purchased in a 1031 exchange, all right, sometimes that seller is also an investor, all right? But what? Hey, they don't know anything about 1031 exchange either, right? Maybe, again, if you're the one that brings it to the table for them, who knows? Maybe you can help help them find some replacement property. Maybe you can pick up another transaction. All right. Now y'all think about this for a minute. Any property out there that is non-owner occupied is a potential 1031 exchange candidate. Why? Because if they don't live in the property, they might be holding it as an investment, right? Now, there's databases that you guys can tap into to get those kind of leads. There's one that I know of. It's referred to as List Source, all right? Now, List Source is a product of CoreLogic. You know, probably have heard of CoreLogic. They're a huge data company, right? Now, within List Source, okay, you can actually do searches by zip code, geographical area, subdivision, and so on, all right? And what it'll give you the mailing address, and it'll give you the property address, all right? If those two addresses are different, you know they don't live in the property, all right? You could target that mailing address to the actual owner of the property. Because why? Because, you know, we see this all the time. Somebody will own an investment property. You know, they own that rental property, right? And they've owned that thing for years, right? And they know if they ever sell that property, they're going to be looking at a huge gain, and they're going to have to cut a check to the government. And you know what? They just don't want to cut that check. So what do? They just hold on to that property, not knowing that they have any other options. Again, if you're the one that targets that mailing address, you target that owner, you say, hey, you do have an option, all right? You can do a 1031 exchange, defer all those taxes. Let's go out and find you something better. Who knows? Maybe they can go from one investment property. Maybe they can pick up two investment properties with two tenants, all right? Two different income streams per month. So they go from one income stream a month to two income streams a month, and hopefully they're going to be making more money. And, you know, they're not going to be so reliant on just having that one income because, hey, if they lose that tenant, well, they got another income stream coming in, right? Now, you could even target the property address. Why? Because maybe they have a tenant in the property. Maybe the tenant's looking to buy something. Who knows? Maybe they're looking to buy the property that they lived in for all those years, but what? The owner was never willing to sell it to them, right? All right, so now there's other databases that you guys can tap into too. People tell me within your MLS system, you have something that's referred to as IMAPs, all right? There's a fairly new product called Remind, all right? Also, depending on the county, all right, the property appraisers offices. Some property appraisers offices here in Florida let you search by absentee owners, all right? Same thing with IMAPs and Remind, they let you search by absentee owners. Absentee owners, they don't live in the properties either, right? They might be holding them for investment. Right. So, you know, if you've always thought, gosh, I really would love to be able to get more business or get my foot in the door with investors, how do I go about doing that? Well, you know what? Maybe 1031 exchange becomes a tool that you can use to get introduced to investors. All right. So good. Some things to think about, right? All right. So let's cover we're going to cover the 1031 exchange guidelines. It's still looking good on time. All right. We're going to review the property qualifications for those of y'all that weren't in on the basis class. All right. Tax deferral requirements. We're going to talk about some timelines, and we're also going to review some of the identification rules. All right. So property qualifications. All right. Again, any type of real property, all right, that you hold for investment or you're using your trade or business, all right, you can sell that in the 1031 exchange, and you can replace it with any other type of real property. It's referred to as like-kind property that you use in your trade or business or that you hold for investment, all right? And those properties can be located anywhere in the United States, including Guam or the U.S. Virgin Islands, all right? Puerto Rico is not included in that number, all right? So now what property is excluded? We've already mentioned your primary residence, right? You can't do a 1031 exchange on your primary. What do you do for the primary? Again, you might qualify for that section 121, all right? Now, property held for sale is excluded from 1031 exchange. What exactly is that, right? Let's just say I'm a builder, right? You know, in the state of Florida, we have a lot of these like national builders, home builders like Pulte Homes, Lennar Homes, KB Homes, all right? Let's say I'm Pulte Homes, right? So Pulte, they build properties all over the United States, right? Multiple states. The properties that they build, when those properties are completed, what do? All right, they turn around and sell them, right? So because they're holding those properties for sale and they're not holding them for investment, well, they can't do 1031 exchanges on those types of properties, right? Because they're held for sale. Now, dealer property might be somebody that we considered a flipper, right? You know, they buy a property, I don't know, 2 or 3 months goes by, they fix it up, and what do they do with it? Well, they turn around and sell it. Well, you can't do 1031 exchanges on those types of properties, right? Because they're holding them for sale. You know that's like their business. That's like their inventory, okay? They're fixing those properties up and they're turning around and selling them. Well, you can't do 1031 exchanges on those types of properties. Now, what if I'm a flipper and let's say 2 or 3 months goes by, I fix it up, and instead of selling the property, they go to their realtor and they say, "Hey, can you put this in the MLS system and show it for rent? Let's put it in there for fair market value rent." Well, that's a little different, right? Because why? Because now all of a sudden they're showing their intent that they're holding it for investment and they're not holding it for sale, all right? I mean, who knows? Maybe they show it to a potential renter and they run a credit report on that potential renter and they have horrible credit and they decide not even to rent the property to them, all right? Again, you have to be able to show your intent. If that flipper gets audited, the IRS comes in and says, "Hey, prove to us you held that property for investment and not for sale," they're going to have to be able to back it up. All right. In the example I gave you guys, they could back it up. They could say, "Look, here's the day I sent a email to my realtor saying I wanted to put it in MLS for rent at fair market value. Here's the day I went into MLS. Here's the MLS listing showing it for rent. Here's the day I showed it to the potential renter. Here's when we ran the credit report." All of that stuff is going to be their backup. It's going to be their ammunition, their trail of breadcrumbs, right, to prove that they held the property for investment and not for sale. All right. If they just strictly turn around and sell the property after fixing it up, can't do a 1031 exchange on it. All right. Foreign property is excluded from 1031 exchange. All right. So I couldn't sell a property here in Florida in a 1031 and try to buy replacement property, let's just say in Canada or Mexico or somewhere in Europe, all right? It has to be what? It has to be domestically located property, including Guam or the U.S. Virgin Islands, all right? So foreign property is excluded from 1031 exchange, all right? Now, what are the rules? Guideline number 2. So the rules to get a full tax deferral, to defer your taxes 100%, are this, all right? Rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value. Now, what are the net proceeds? Well, the net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing, all right? Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange, all right? So they have to take that entire amount and they have to go out and they have to buy a replacement property, or it can be a combination of properties equal to or greater than whatever the sales price was on the property that they sold. That's rule number 1. Now, rule number 2 is if they have any debt, like a loan that they're paying off, okay, you must acquire an equal amount or greater debt. Now, that rule can have an exception, all right? If they happen to have cash that they can add to the purchase of the replacement property, they can offset of having acquire any debt or any additional debt, all right? Now, here's an example of how the numbers work, all right? Let's say we go out and we sell a property for $1 million, all right? Now, we have a loan that we're paying off. We have debt that we're paying off of $300,000. So we'll take that $1 million sales price, minus out the payoff amount, the debt of $300,000. Now we have some cost of sales of $50,000. That's like real estate commissions, title insurance, closing fees, some of those non-reoccurring type of fees. Let's just say that's $50,000. So we'll deduct out the $50,000, and that would actually give us proceeds of $650,000. Now again, we're the qualified intermediary. We're going to hold that $650,000 on behalf of the seller, the exchanger, right? And what are they going to do with that $650,000? Well, in this case, they're going to go out and they're going to use it towards buying a replacement property for $1.2 million. All right, so they just met rule number 1. Why? Because they used the entire net proceeds, and they actually are acquiring a property greater than what they sold. All right, they sold for $1 million, well, they're buying a property for $1.2 million. All right. Now, if you think about the numbers, right, they still need another $550,000 to help them buy that property for $1.2 million. So what do they do in that case? Well, they go out and get a loan for $550,000. By doing that, they actually meet rule number two. Because why? Because they actually acquired greater debt. They had a loan of $300,000 that they paid off. Well, they actually got greater debt. They increased their debt because they got a loan for $550,000. So in this particular example, they would get a full deferral to defer their taxes 100%. Okay. Now, what if they wanted to do this? What if out of the $650,000 they said, well, we'd like to take $100,000 of that 650. We want to put that in our pocket. All right. We only want to use 550,000 of it to help go out and buy a replacement property. Well, they can do that. All right. But that $100,000 that they put in their pocket, they're going to be subject to taxes on that amount. All right. They can do whatever they want with that $100,000. All right. But again, they're going to be subject to taxes on that amount. It's referred to as cash boot. All right. It doesn't mean that they can't do a 1031 exchange. All right. What it means is instead of getting a full deferral, they're going to get a partial deferral. Partial why? Because hey, they're going to be paying some taxes on that $100,000 cash boot that they held back. All right. So back to the example. They take the $550,000 and they actually use it to go towards buying a property of less value. They only buy a property for $800,000, right? Now they still need a loan. They still need an additional $250,000 to help them buy that replacement property of $800,000. So what do? They get a loan for $250,000. But by doing that, they actually go down in debt by $50,000, right? Because they had a loan of $300,000, they only got a loan for $250,000. Well, that's $50,000 less debt. They're also going to be subject to tax on that amount. All right, it's referred to as mortgage boot. All right, so there's two types of boot. There's mortgage boot and there's cash boot. All right, again, it doesn't mean you can't do a 1031 exchange. It just means that you're going to be getting a partial deferral instead of a full deferral. Again, why? Why partial? Because you're going to be paying some taxes on the mortgage and the cash boot. You know, if anybody ever wants to do anything like this, I always tell them, talk to your CPA because you really need to look at your numbers, right? And say, look, what is it, if I sell the property outright, what's my taxes look like if I don't do a 1031 exchange, all right? But if I sell the property and I do a 1031 exchange, but I pay some taxes on the boot, what does my taxes look like? All right. If that generally that tax is going to be less than you selling the property outright. But if for some reason that tax is actually greater than you selling the property outright, don't do a 1031 exchange. All right. It's not going to be worth your while. You're going to lose money. All right. So again, always talk to your CPA. Always get your taxes, get your information from the CPA. All right. Because they're going to know your taxes inside and out. Better than anybody else. All right. Now, guideline number 3, there's some timelines that everybody needs to be aware of. All right. So for when you sell your relinquished property, all right, you're going to have 180 calendar days to purchase your replacement property or properties. All right. And that's calendar days. That's holidays. That's weekends. All right. Hey, those of y'all on the line that live in Florida or anywhere on the East Coast. Okay. From June to the end of November, we're subject to, or even the Gulf Coast, we're subject to hurricanes, all right? If we're getting hit with a hurricane and everything shuts down for a day or 2 or a week, whatever it may be, it does not matter, all right? That clock is still going to be ticking, all right? So it's 180 calendar days to purchase any replacement property or properties, all right? The first 45 days of the 180, right, that's referred to as the identification period. Now, what exactly is that, right? Well, the identification period is you must identify any potential property or properties that you want to buy, all right? Now, that's something else that we assist with, all right? We're going to provide a form to the client, the exchanger. It's called the identification ID letter. And on that form, there's blank lines, all right? And it's going to have to be specific to a property address or addresses, all right? And they're going to have to complete it, fill it out, complete it, sign off on it, and get it back to us by midnight of the 45th day, all right? That's how they formally will identify their replacement properties. They will identify them to us, the qualified intermediary. None of those properties even have to be under contract, okay? They just have to identify any potential property or properties. But here's the thing. If they find the perfect property, let's just say on day 46, it's too late. All right. So whatever they identify, they're going to have to make sure they're going to be able to buy at least one of them. All right. So what's the best way to lock up a property? Put one of them under contract. So that's generally what we see, all right, is somebody will put a property under contract. That's one of the ones they identify. And then I don't know, maybe they'll identify two other properties just as backups, because after midnight of the 45th day, if anything happens with that contract, say that whole contract falls apart, well, at least they have the opportunity to buy those two other properties that they would have identified. All right. So 180 days to close. First 45 days, you have to identify any replacement property. All right, now, update. Everything that's going on with the COVID-19, all right, everything's kind of been, at a standstill. Things are really slow, all right? Well, as of April 9th, all right, the IRS has actually granted some additional extensions to the timelines, all right? Now, very rarely do they even grant extensions for anything, all right? Typically, it has to be some type of federally declared disaster area, all right? So what they've done with the COVID-19 shutdown is they've said anybody that has a 45-day, their 45-day date falls between April 1st and July 15th, all right, they're going to automatically be extended to July 15th. It's actually April 1st to July 14th. They're going to be extended to July 15th, all right? Anybody that has their 180th day that falls between April 1st and July 14th, their 180th day is going to be extended to July 15th, all right? Now, here's an example. Let's say taxpayer Bob, right? He sold this property March 1st of this year. Now, his 45-day normally would be on April 15th, okay? His 45-day clock. Now, because it falls between April 15th and July 14th, he's automatically going to get his 45th day extended to July 15th. Okay. Now here's another example. Taxpayer Sue. All right, Sue. She actually sold her relinquished property last year, October 4th, in 2019. All right. Now her 180th day would have normally been on April 1st of this year, because she falls between the timeline April 1st and July 14th. Her 180th day has been extended to July 15th. Okay. Now, let's talk about guideline number 4, and we're getting a little short on time. There's some rules to identifying, right? There's 3 different rules. I'm going to read you the rules. If you don't understand them, don't worry about it, because I have examples I'm going to show you. I'm going to walk you through the examples of how all 3 of these rules work, all right? Now, the first rule, it's the most popular rule that we see, all right? Probably 90 to 95% of all the exchanges that we do fall under this first rule, all right? It's referred to as the 3 property rule, all right? And the 3 property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. Now, what exactly does that mean, fair market value, right? If you identify 3 properties or less, the purchase prices of any of those properties, all right, can be any dollar amount. It does not matter. All right. Now, if you want to identify more than 3 properties, you can do that. But you're going to fall into this next rule. It's called the 200% rule. And what that states is you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean? Well, if you identify more than 3 properties, all right, the purchase prices of all those properties, the combined purchase prices of all those properties that you identified, cannot exceed 200% or 2 times whatever the sales price was on the property that you sold. All right. Now, if you don't understand that, again, I'm going to show you the examples. Hopefully, when I show you the numbers, it'll really click for you. All right. Now, if you want to identify more than 3 properties, and you also want to exceed the 200% rule, well, you can do that. All right. But you're going to fall into this next rule. It's referred to as the 95% rule. Now, the 95% rule, it's rare that we even see it gets enacted. All right. It doesn't make a lot of sense, guys. But just remember, everybody, this is the IRS, and sometimes this stuff just doesn't make sense, all right? Because it reads like this: you can identify over 3 properties, you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. Now, I know that's probably about as clear as mud, right? Well, here, let me show you other examples, of how the numbers work for all three of these, especially this one. Hopefully it'll click for you. All right. So three property rule again. If you identify three properties or less, all right, the purchase prices can be any dollar amount. It doesn't matter. So here's an example. We sell for $1 million. We go out and we identify three properties, all right? So we're in the three property rule. Now let's just say we're buying each one of them for $1 million. So we've identified $3 million worth of property. Again, we could be buying each one of those properties for $10 million a piece, all right, for a total of $30 million in identification. It doesn't matter, okay, as long as it's three properties or less, all right? But what does matter, and I'll say it again, all right, if you identify three properties, you better make sure you're going to be able to buy at least one of them. Again, put one of them under contract. That's typically what we see, all right? And then maybe you have those other two as backups, just in case if something happens with that one property. If you don't put any of them under contract, you identify three, one of them burns down to the ground, one of them gets sold, you will only have the opportunity to buy that one property if it's after midnight of the 45th day. There is no exceptions after midnight of the 45th day. You are locked into whatever you have identified, okay? So that's the three property rule. All right, the 200% rule. Again, this is where you exceed the three property rule, all right, but you cannot exceed 200% or two times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now we go out and we identify five properties, all right, because we've identified five, we exceeded our three property rule, right? So that puts us into the 200% rule. So what that means is the combined purchase prices of all five of those properties cannot exceed $2 million. Now, where am I getting the $2 million from? We sold for $1 million, right? 200% of $1 million that we sold, or two times $1 million that we sold, is $2 million. All right, that's pretty straightforward, right? Hopefully everybody got it. Or gets it. All right, now here's that 95% rule. Again, doesn't make a lot of sense, right? It's a crazy kind of screwy rule. What it states is if you can exceed the three property rule, you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. Okay, so again, we sell for $1 million. Now we identified 10 properties, all right? Because we've identified 10, we've exceeded our three property rule, right? Now let's keep the numbers really simple. Let's say we're going to be buying each one of them for $1 million each, right? So we've identified $10 million worth of property, right? Well, because we've identified $10 million worth of property, we just exceeded our 200% rule. Because why? Because that number was $2 million, right? So that puts us into the 95% rule. So in our example, let's just say we only acquire 9 out of the 10 properties, all right? That's only 90%, or $9 million. That's not 95%, right? If we do that, if we only acquire 9 out of the 10 properties, we actually blow our entire exchange and we have to pay all of the taxes, okay? So the reality of the 95% rule is really 100%, all right? Of whatever you identify, you're going to have to buy. And you know what? We're using really simple numbers. We're saying everything's going to be an even $1 million. You know what? Those purchase prices are going to be all over the map. It's going to be really hard to sit down and say, okay, let's see, if I get this property, wait, that's only 93%. All right, well, maybe I need to make sure I get this other property. Oh, wait, that only puts me at 94%. 95% rule is 100% of whatever you identify, you're going to have to buy. All right. The IRS, they don't want you identifying everything under the sun. All right. Because if you do that, if you identify everything under the sun, guess what? You're going to have to buy everything under the sun because of this crazy 95% rule. All right. So let's talk a little bit about some of the various types of exchanges. So, you know, everything that we've talked about today, the most common type of exchange is referred to as a delayed exchange, all right? And that's exactly what we've talked about. You sell your relinquished property, all right? The first 45 days, you have to identify replacement property. And then by day 180, you're buying your replacement property, all right? So it's where you sell first, you sell your relinquished property first, you're buying your replacement property last, all right? That's a delayed exchange. That's 90 to 95% of all the exchanges we do are delayed. But there's another type of exchange, all right, or a few different types of exchanges. One that's referred to as a reverse exchange, all right. Now, the reverse exchange works just the opposite of a delayed. It's actually where you buy first, you're buying the relinquished property first, and you're selling last, all right. Make it work something like this. Let's say you have your property listed for sale. Maybe you don't even have a contract on it yet, right? But you go out and you find that perfect replacement property, right? Now, you know it's a seller's market, right? And you know if you don't act fast, you're going to lose the ability to be able to buy that replacement property, that perfect replacement property, right? Because it's going to get sold, right? So what can you do? Well, you can do this thing called a reverse exchange. What happens in the reverse exchange is we actually come in and we form an LLC, right? It's also referred to as an exchange accommodating title holder, right? EAT for short. We come in and we purchase the replacement property before you sell your relinquished property, all right? Now, when we purchase that replacement property, if it has tenants in it, all right, we can even do like a triple net lease back to the seller, but the exchanger, so they can benefit from any lease monies that are coming in, okay? Now, when we acquire that replacement property, you must be able to sell your relinquished property within, anybody? 180 days, okay? The 180 doesn't go away. It's still coming into play. All right. Now, what are some of the advantages or positives when you do a reverse exchange? All right. Well, as I mentioned, hey, it's a seller's market. You have to act fast to be able to get that replacement property. What can you do? All right. Well, again, you can do the reverse exchange. Now, what if you did this? What if you listed your property and you thought, man, my property is the greatest property in the world, right? I'm not going to have any problems selling it. You never have sellers that think that, do you? Of course you do. All of them think that, right? Everybody thinks they have the greatest property in the world, right? So what do? They go out and put a contract on a replacement property. And then what happens? Well, slowly but surely they realize maybe I don't have the world's greatest property because I'm not getting all those showings like I thought. I'm not getting all those offers like I thought I would get. But guess what? You already put a contract on a replacement property. You're obligated to buy that property now, right? And that closing date is fast approaching. You need to do something. All right. Well, again, you can do the reverse exchange and save the whole deal. Now, what's the negatives? What is the biggest obstacle to overcome in a reverse exchange? Well, it's the financial part, all right? Hey, we're a great company, right? But we're not just going to come out of pocket and buy the replacement property, all right? The exchanger is going to have to be able to give us the funding to be able to do that, all right? Typically, it's going to have to be cash. Now, why do I say cash? Because if they're trying to get a loan to buy that replacement property, lenders typically are not going to loan funds in those kind of deals. Because why? Because we're not the borrower. They are, okay? We're actually going on title. They aren't, okay? Lenders typically aren't going to lend those types of funds at that point, all right? Now, hey, maybe if they have a great banking relationship, who knows? Maybe they can get some type of line of credit, something like that, all right? Some people tell me some of these hard money type lenders will loan on those kind of deals all day long. For us, it really doesn't matter. Just some way, somehow, that exchanger is going to have to be able to give us the financing for us to be able to buy that replacement property, all right? What's the other negative? Well, I already mentioned it, all right? You must be able to sell your relinquished property within 180 days, all right? What happens if you don't sell your property in 180 days? Well, guess what? You're going to own two properties, all right? We're not going to hold on to it, all right? You're going to own two properties. Now, you're not going to have to pay any capital gains taxes and everything else, depreciation, because why? Because you never sold anything, all right? Now, if ultimately you say, well, I still want to sell that property, you can do that, but you're going to have to designate a new replacement property because why? Because you can't exchange it to something you already own, and you would have already owned that property because we would have transferred it back to you on day 181, all right? So that's how the reverse exchange works. Now, there's another type of exchange. It's referred to as a construction exchange, all right? Another term you may hear people refer to it is an improvement exchange or a built-to-suit exchange. They're kind of all one and the same, all right? They can work something like this. Let's say you sell your relinquished property, right? Now we're the qualified intermediary, right? We're going to be holding the proceeds on the exchanger's behalf, right? Now they go out and they find a replacement property, but they want to do some improvements to it before they actually acquire it, all right? Well, they can do this thing called the construction exchange, improvement, built to suit exchange, all right? What happens in that case is, again, we come in and we form that LLC, that EAT. We can take the proceeds that we're holding and we come in and buy that replacement property, and then we oversee any construction, any improvements that are taking place. All right, we're working with the contractor or contractors. We're handling disbursements, paying those contractors, the whole boat. Okay, now those improvements need to be done within 180 days. All right, there's the 180 coming back into play. All right, so that's the basics of how a construction exchange works. Those can be extremely complicated. So can the reverse exchanges. All right, but that's referred to as a construction, improvement, or built to suit exchange. All right, now there's another type of exchange. I call it a no appreciation exchange or a non-appreciation exchange. All right, sometimes you may have somebody that falls into this category. They say, well, I bought my property in the height of the market. All right. And now I've owned that property for years. Okay. Now I'm going to sell the property, but basically I'm selling it for what I bought it for. So on the surface, they may be looking at it saying, gosh, I have no gain because I'm selling it for what I bought it for. But the problem is this. Remember depreciation recapture tax, right? That 25% tax. They're still going to be responsible for paying that 25% depreciation recapture tax on any depreciation that they've claimed. All right. Here's a quick example of maybe how it can work. Let's just say they originally purchased the property for $1 million. All right. Now they've owned it for years. Okay. And they're going to sell it for $1 million. So again, they might be sitting there saying, hey, I have no gain. All right. I don't need to do a 1031 exchange. But the problem is this. Let's just say they took $200,000 worth of depreciation for the entire time that they've owned the property. So when they go to sell that property, they're going to be hit with that depreciation recapture tax, that 25% tax on that $200,000. That's going to equate to a $50,000 tax bill when they sell that property. All right. They can still do a 1031 exchange on that, on the depreciation recapture tax and defer that. All right. So again, don't always think, especially if you're a realtor and your client is sitting there saying, hey, I have no gain. I don't need to do a 1031 exchange. Just ask them. Say, look, have you talked to your CPA? Have you talked to your tax advisor? Have you gotten your numbers? All right. Because again, you don't want them to be in for a rude awakening when they go to sell that property. All right. If you ever have a client that's sitting there saying, yeah, I bought this property with the 1031 exchange, and they're not talking about doing another 1031 exchange, that should be a red flag as well. Because remember, 1031 exchange is a tax deferral. If they don't do another one, they may be subject to having to pay taxes. Sometimes this happens. Somebody says, well, I bought this property in a 1031 exchange. Now, the property that I'm selling, I'm actually selling at a loss. All right, I don't need to do a 1031 exchange because I have no gain. I'm selling at a loss. But guess what? That loss may not be enough to offset the gains that they deferred in the past when they did the 1031 exchange to acquire that property. So they may still have a need to do another 1031 exchange. Again, always talk to your CPA, talk to your tax advisor, your accountant, and get your numbers. All right. All right. Last slide. We're good on time too. So what do we charge for the various types of exchanges? Well, a delayed exchange, right? The most common type of exchange, right? That's again where you sell first, you buy last. Our fee is simple. We charge $750 on the sale. We don't collect anything until it actually closes, all right? If it doesn't close, all right, we don't charge anything. We don't charge that $750. We don't charge any kind of cancellation fees, wiring fees, junk fees, anything like that. Those in the line that are realtors, all right? You don't earn your commissions until it closes. Well, hey, we don't earn our fee until it closes either. All right, so we charge $750 on the sale, and then we charge $250 on the purchase of the replacement property. All right, so you sell one property, you buy one property. Our total fee is $1,000. That's it. All right, it could be a $100,000 deal or a $100 million deal. It doesn't matter. $750 on the sale, $250 on the purchase. All right. Reverse exchanges. All right. Again, that's where you buy first, you sell last. All right. The construction, improvement, built to suit exchanges. All right. Those start off at about $6,500. All right. They can be significantly more complicated than the delayed exchange. All right. We're forming a separate company. We're going on title. We're working with contractors in the construction exchange. All right. They start off at about $6,500. All right. All right, so that's it. We're going to wrap it up. We're right at 12:15. Perfect timing. I'll open the floor up to questions. While we're waiting for questions to come in, I'll mention this again. Again, a lot of what we talked about today I have in PDF form. If you want those PDFs, please let me know. Just shoot me an email, give me a call. I'll be glad to get those PDFs over to you. If you have clients that have 1031 exchange needs, hey, don't feel like you have to be a 1031 exchange expert. I'd be glad to talk to them. Or I talk to people all day long about 1031 exchanges. It could be something as simple as, hey, I have a listing. I'm thinking about listing my property. I want to know some of my options. Talk to me about they want to know what a 1031 exchange is. If you individually have your own investments, I'd be glad to talk to you as well. All right, send them my way. If I send you that email, sometimes people will forward that email and CC me on it, introducing me to their clients, and I can take it and run with it. All right. Those of y'all that are in the line that are realtors in Florida, all right, I do have a 2-hour continuing ed class that I do in a classroom style. I'll come to your office and teach it in person. I do a lot of classes for boards of realtors, real estate offices, that continuing ed class. I even do this class and my basis class in live. Right now, I can't do any of that because obviously we have to do everything from home. But in the future, if you want me to come to your office, let me know. I'd be glad to set something up with you. I cover the entire state of Florida, at least mobilely. I can handle any other state, but for those in-house classroom style learning, I can do it in Florida. All right, so let's see, questions coming in. For the 200% rule, do you have to buy all of the properties or just any one? You don't have to buy all of the properties, no. You still have to meet your equal to or greater than, all right? But as far as the identification goes, you can't identify anything greater than the 200%, or if you get into the 95% rule, that's where you have to acquire at least 95% of the value that you identified, all right? So hopefully that answers your question. If not, hey, give me a call or shoot me an email. We can talk offline. Let's see, any other questions coming in? All right, doesn't look like it. A little over the time. Well, I'm going to go ahead and I guess I'll just wrap it up. Hey, if there's a question that pops into your head after we finish today, hey, just let me know. Again, everybody's going to receive a link to today's recording, so be on the lookout for that. It'll probably come within the next day or so. The recording has to upload and all this other stuff it has to do on the back end. Be on the lookout for it. I appreciate everybody hanging in there with me today. Thank you for attending. If today's class was a little bit over your head, it was an advanced class. I do have another class coming up in May, a basics class. It's going to be on May 11th. We're going to do it from 2 to 3. The advanced class, I have that again. I'm doing in May as well. It's going to be on the 18th from 2 to 3:15. If y'all want to attend it again, or you have friends that maybe you want to have them attend, be on the lookout. I have a newsletter. It'll have the link in there for the registration for the other classes. If you want to attend the basics, because hey, today was a little over my head, feel free to join in. All right. All right, so we'll go ahead and wrap it up. Appreciate everybody hanging in there. Thanks for attending today. Let me know if I can do anything for you in the future. And everybody, please stay safe and stay healthy. Thank you. Bye-bye.